Is Alibaba back? Last week, they reported a huge beat on revenue and earnings per share. They were up initially. Now they're down today, 2.5%. President Biden reported, Mo was laughing, President Biden announced that he is going to put a AI restriction on investing in companies that do AI in China. Could this affect Alibaba? I'm sure Alibaba is going to get very active in the AI game because they're big on cloud computing. But let's go check out Alibaba today. Guys, in this video, we're going to go over basic things for early investors, more advanced things for advanced investors. There's something for everybody here. Watch the whole thing. Bull and bear cases, analyst estimates, our famous 8 pillars, and culminating in our stock analyzer tool, which will tell you what price to pay for the company, but we're here to teach a process. And guys, full disclosure, I own Alibaba stock, but you should not own it just because I own it. We're here to teach you a process. We're here to decrease the anxiety and stress of investing so you can have a process that you can apply to your own investing standards, just like I've done, just like Mo's done. Mo and I disagree on a lot of things, even though we're on the same channel and we use the exact same software. So again, pay attention to this video. If you don't already subscribe to us, subscribe to the channel. You'll learn a lot. Just keep watching our 2,200 plus videos. You'll love it. So Alibaba's down $2.50, $2.25 today. Market cap, $240. That means if you want to buy every single share of stock outstanding in Alibaba, you pay $240 billion for that. Now, guys, look at the all-time high here. October of 2020, $320 a share. At that time, the company could do no wrong. Hit a low of $58 just 9 months ago. Back then, the stock could do no right. And all the news was negative. But remember, news follows the stock price. I cannot stress that enough. Your job as an investor is to take away the stock from the news and decide what the smart thing to do is there. Go ahead, Mo.
The news is the same now. The funny thing was I was reading comments from our earnings video and somebody wrote, Mo said that there was a lot of fear about China at $180 a share. I'm like, yeah, there was fear at $320. There was fear at $58. There's still the same fear. Fear is communism.
But I think that
the narrative hasn't changed for Alibaba.
The concerns about communism
Correct.
and those things all existed wherever the stock price was.
100%.
Now, people exaggerated that fear when the stock fell.
Exactly.
All we could hear about when the stock was falling was, but you guys don't get it. You don't actually own the company. I'm like, well, we didn't own it at 320 either. These ADRs are not actually owning the cash flow of the business. But that was the thing. Now I don't ever hear about that anymore. Mm-hmm. I don't hear about that anymore. Why? Because that is dissipated because the stock has stayed down for a while.
Right.
That's what I want. Whenever the stock falls, people will look for a reason why they have to hate the company. And it could be valid, and probably most times it is valid. But your job to be a successful investor is to determine when there's a split between reality and the actual price and value of the stock. Michael Burry, famous Michael Burry, bought Alibaba sub 100. Charlie Munger bought Bob at 250, and he said it was the worst investing mistake he made or something like that. But guess what? He still owns half his position. Mm-hmm. So everybody's going to have a different outlook on it. But guess what? 250 is a lot different than 90. Okay, so 5-year PE, 15. 1-year PE, 20. Profit margin last year was 9.4%, and the 5-year profit margin is 15.8%. Now, guys, one thing I'm going to look at here. Let's go to the income statement. And remember, for our software, because of the way China reports, we go to the annual. Last year, they showed $10 billion in profit, okay? Now let's go to the free cash flow statement. But they reported $22.8 billion in free cash flow. We love that. When the cash flow is higher than the earnings, it shows that there are some write-offs. Because remember, earnings gets changed by SEC rules, accounting rules, GAAP, all these things. Cash flow has its rules, but they're more indicative of the real financial health of the company. So I love the fact that their average free cash flow in the last 5 years has been $18.7 billion, when their average earnings has been $14.4. That's a huge thing. So let's go to the 8 pillars here. And remember, guys, if you have our software, you can customize your pillars up to 12 different pillars in 4 quadrillion different versions. But Mo, look at this. There's only 2 X's here.
Yeah.
ROIC is low. Okay. That's interesting. Mm-hmm. And net income is down over the last 5 years. Yep. Okay. Also interesting. But everything else is a check mark.
Yeah, it is.
And they have a stock buyback program because they realize that's what I love. Remember, guys, we love stock buybacks as long as they're buying back cheap shares. And the second their stock started plummeting, they were like, listen, we're going to buy back shares. I loved it because most companies, they'll buy back their shares at sky-high valuations, which makes no sense to me. You want a company buying back their cheap shares. So before we go further, Mo, can you go over some bull and bear cases for Alibaba? I'm sure we have 1,000 bear cases, but go ahead.
Yeah. So the International Digital Commerce Group segment grew order growth 25% year over year.
Okay.
Now, this is the order growth under this local services group. So this is like food delivery services, et cetera.
In China,
increased 35% year over year.
Wow.
So I think a lot of this, like these numbers, they're big, but a lot of it is, remember, they were COVID zero policy for quite some time.
You're right. I always forget that.
This is coming off of that. So these numbers look huge, but it's good that they're getting back to growth. It's better than shrinkage.
Of course, shrinkage.
So, all right. A couple of bear cases. The cloud segment
China
is still underperforming heavily, just 4% year over year.
For cloud?
Yeah. Isn't that weird?
Yeah, that is weird.
Because that's supposed to be like your dominant space, AWS and
all the big
Azure
companies
and all
here.
that. Yeah.
Although those growth rates have slowed down significantly to low double digits.
That's true. Not low single digits, though.
Yeah, that's true.
Macroeconomic trends in China real estate are worrying. We were talking about this morning or last night with Dalton.
Yeah, and that's an issue. But guys, China's average, the GDP per capita in China is $12,000 a year. In the US, it's like $70,000 a year. China has 1.6 billion people. Now, they had their first decline in population in 60 years last year by 800,000. But I look at this saying, China's got the fastest growing middle class in the world. Alibaba is going to be a direct recipient of middle class growth. Mm-hmm. So my take on Alibaba is if you can handle the fluctuations and you believe that China is going to be a more independent and growing capitalist society as time goes on, this could make a lot of sense as long as you pay the right price for the company. Right, Mo?
Yep, exactly.
So, go ahead.
I just want to mention this share repurchase thing real quick. So they've bought back the equivalent of 284.4 million ordinary shares for $3.1 billion US under their current repurchase program.
Hoo-ha!
Well, that's great at these prices.
Listen.
Not at $3.20 a share.
No, $3.20 a share. Well, assuming we're going to do the stock analyzer tool, and it'll tell us. But, okay, so let's go to analyst estimates here. Analysts expected $7.50 in the next year, $8.60 per share in profit on a company that's selling for $93 right now. And they expect it to grow to $13 a share, which is not as much as I would have thought, Mo. No. I would have expected much higher EPS growth, especially with buying back shares and their potential in China.
Right.
Now, could it be analyst estimates bias going, well, the stock is down a lot? I don't know.
True.
Revenue growth, though, this is what's interesting to me. The revenue growth is high single digits. Their earnings growth is low double digits. That seems a little too close. Mm-hmm. But this revenue growth is still there. So for a company that everybody's like scared of, I sit there and go, okay, I get it, but you're telling me that you don't think China's going to be a major player in the world economy in the next 50 or 100 years? Come on.
Yeah, come on, it's right.
So what's the right price to pay for Alibaba? So let's go to the stock analyzer tool. Now, Mo, I'm going to stick with a 10-year analysis. Okay. Now, remember, guys, this stock analyzer tool is one of 8 or 9 tools that we have in our software that allow you to make better financial decisions based on a process that you find that works for you. It's here to help you. It helps me sleep better at night whenever a stock is falling. I go into my stock analyzer tool, I run my numbers and go, yeah, the stock is selling for a cheap price. I'm okay with this. And I go into our community chat where thousands of people are discussing our investments every single day. So guys, if you like the software, if you like the idea of having this, go to everythingmoney.com for about $1 a day. You can have all the software. It'll help you sleep better at night if you use it the right way. Let's run our stock analyzer tool. Revenue growth. Remember, we want to do a low, middle, and high in all of these. Revenue growth is our very first line. Give me some revenue growth numbers for Ali Bizzle.
So I have 5, 8, and 11.
5, 8, 11. I actually like that a lot.
Yeah, 11.
What was that?
11's higher than most analysts say.
Not on revenue growth.
The highest.
Oh yeah, you're right. I'm sorry. You're right. Yeah. You're right. Yeah, I was thinking EPS. Yeah. Okay, what about profit margin? Look at this profit margin. It's down almost half of the last year versus the last 10 years.
Right. So I put in 15, 19, and 23.
Okay, I like that. So they've been affected lower in the last 5 years. So their last 10 years have been 18.6. I could see 23 still happening, but it'll take some effort.
Absolutely.
Free cash flow?
I did 17, 22, and 27. Because it has always been higher.
Okay.
Well, over the last decade, I should say.
So guys, this is part of the hard part, is looking at these numbers and figuring out the right things. And sometimes you're going to have a very wide range, and that's okay. Remember, this is all about probabilities. What are the probabilities of these happening? This is probably more likely than this, but this is somewhere closer to this, low, middle, and high. That's the hard part about investing. This is the art of investing. And that's why if you have our software, this is why so many people in our community say, hey, here are my assumptions about the company. What do you think? And they engage in that regard.
Right.
All right, go ahead, Mo. For PE, which is currently at 20, and price of free cash flow is currently at 8.
So I had 16, 18, and 20.
Okay. Same for both?
Yeah, I put the same for both.
Now, guys, remember, our belief is the market average over long periods of time will be 15. So you should go higher based on a moat, based on revenue growth, return on invested capital being better, and lower for the opposite to occur. This is part of the art of it. It's about deciding. Remember, Warren Buffett paid 30 times profit for Coke in 1987. I would have never done that. Warren Buffett still did very well with Coke. He's made about 11.5% with dividends over the last 30 some years. So that's something to consider when you're making investments. A bigger moat justifies a higher premium. Finally, desired annual return. You can get 9 or 10% from an ETF. Mo, give it to me.
So I did 12, 14, and 16%. And
so,
this is where I factor in the China part of it.
So that's what I like. Even though we beat the company up here, there's still a lot unknowns about China, and there should be a premium paid for that. And as you make higher assumptions, your desired return should be greater, which is a greater margin of safety. I agree with that completely. So let's hit the analyze button. Remember, guys, stay with me through the entire video because we're going to explain these numbers. Don't just drop off because you're going to miss a lot of good explanations because we're here to teach a process. Boom. Low price, 107 to 122. High price of 222 to 260. Middle price of 160 to 180. Guys, if you pay today's price and the low assumptions occur, you're going to make about 16%. Pay today's price, the middle assumptions occur, 25%. Today's price, highest assumptions occur, 33%. So again, I think there's going to be a lot of volatility in this company. But in my opinion, what I'm doing for myself is I'm keeping my position. I'm adding a little bit more to it. But again, don't do it just because I'm doing it. Guys, sign up for the software. It'll give you the ability to make independent decisions. Thank you very much for your time.